Welcome to the Lend Academy podcast, episode number 54. This is your host, Peter Renton, founder of Lend Academy. Well, first, let me say Happy New Year, everybody. I hope you had a great holiday season. And for the first podcast of 2016, we are actually coming to you from the brand new soundproof room here at the Lend Academy offices in Denver, Colorado. I hope you notice the sound quality will be a little bit better. We've got a pretty cool setup here. We've had a sound engineer working on getting us a room that has no background noise and higher quality equipment. So hopefully you will hear the benefit of that. And for our first guest of the new year, we're probably going with the highest profile person in our entire industry, and that is the CEO and founder of Lending Club, Renaud Laplanche. Now, Renaud doesn't need much of an introduction for those of us who've been around the industry for a while. But I wanted to get him on the show because it's a new year and Lending Club had a fantastic 2015, and I wanted to find out what was in store for 2016. Talk about some of the issues of the day. We cover acquisitions, we cover partnerships, we cover risk, we talk about regulation, self-regulation, and more. So I hope you enjoy the show. Thanks. Okay, welcome back to the podcast, Renaud.
Thank you.
Okay. So I want to start off with just talking about your year. I mean, you went public in December last year, just over a year ago, and I wanted to get your take on how this year has been. It's the first year as a public company, and any surprises that you've encountered during your reign so far as a CEO of a public company.
Yeah, thank you, Peter. Yeah, so it's been a great year. I mean, we're almost twice as big now as we were a year ago. We've continued to report extraordinary growth rates and over 100% or close to 100% year-over-year growth every quarter since we went public, while sort of getting more efficient and expanding margins. I think the main thing the IPO has done for us is really helping us establish the brand and the reputation of the company. And I think operating as a public company with all the transparency that comes with it has really helped us establish new partnerships and build the reputation of the company publicly. So all that's been good. In terms of surprises, I think I've been surprised with how with sort of inside baseball kind of comment I'd make is how stock price variations in the first year as a public company are more dependent on supply and demand, and particularly the lock-up expiration and distribution of shares from the VCs than it is dependent on actual fundamental results. And what we're hoping in our second year as a public company, all that will normalize, and I think the stock performance and the company performance will start converging.
Right. Yeah, that makes sense, because as I say, your company has had a great year, and pretty much any metric you want to look at, hopefully that will be reflected at some point. And I should disclose too, I am a stockholder in Lending Club as well. So anyway, I just want to talk.
Good for you.
I want to talk a little bit just personally. What have you been focusing on yourself in the last 12 months?
So a lot of fundamental company building activities. I think I spent a lot of my time on strategy, product, and org design. We were really sort of setting up the operations, the technology platform, and the product roadmap in a way that prepares us for fast growth, not just next year, but over the next 3 to 5 years. And that took a big lift from the team this year. I think we're at a place that really set us up well for the next few years.
Mm-hmm. Okay, so you have a lot of cash on your balance sheet. I think many people, myself included, were expecting you to start making more acquisitions, particularly when the acquisitions are sort of additive to your to the loan book, and you obviously haven't made any this year. So what is your approach to the cash in your balance sheet? And I know you're not going to give anything away, but what can we expect from you going forward with regards to acquisitions?
Yeah, no, certainly we have a lot of cash from the IPO, and we're generating additional cash every quarter. And so we don't just need that cash as a matter of funding the operations. And certainly the most likely use of IPO proceeds is going to be acquisitions that are sort of accretive to the growth of the company and essentially help us accelerate the roadmap. We've looked at a few potential targets this year. We haven't seen anything that meets our criteria or our standards, but we certainly continue to be active in that area.
Right, but it doesn't sound like you're only focused on acquisitions because, in your last earning call, I think the last two earning calls, if I'm correct, you mentioned that you're launching a new product in the first half of next year. I think you mentioned recently it was a consumer lending product, but for those people who weren't on the earnings call, can you just give us a little bit of information about that?
Yeah, no, fairly. So we're gearing up for a major product launch that's still on track for happening the first half of next year, of 2016. We said that we'd be sort of entering an entirely new sort of large consumer credit category. We haven't disclosed which one yet, and it's not just for a matter of keeping it secret. It's really that we want to be sort of ready to give more details behind it when we launch, and it's a little bit premature to do that now. But we're very excited about the potential there and about just continuing to make credit more affordable for consumers in areas where they need it the most and where it truly matters for their daily lives.
Okay. So, also on your earnings call, there was a big discussion. There's a bit of discussion in the industry the last few months about customer acquisition costs. A lot of the newer companies are seeing their costs rise. It's more expensive these days to start a marketplace lending platform, it seems. And yet, when you look through your costs in your public filings and you mention on your earnings call that your acquisition costs are actually going down. Can you explain how you're able to do that?
Yeah, I think it really comes to some of the network effects we've described in the past, and the fact that the larger marketplace becomes more attractive and more efficient over time. There are a number of areas where these network effects manifest themselves in terms of rates, in terms of credit bots, in terms of online reputation and the size of the existing customer base. Certainly in terms of rates, we've seen many platform investors being willing to take a lower return on average than what they would demand from a newer or smaller platform. And that really helps us lower the rates to borrowers and generate not only greater marketing efficiency, but also greater quality and positive selection in terms of borrower quality, which helps reinforce the track record, which continues to make platform investors more confident. So that's a really nice flying wheel there. With our highly diversified investor base on the platform, we also have a broader range of credit spectrum we can play in. And that certainly helps with marketing efficiency. And then the last point is reputation. I think the IPO has helped raise brand awareness, but I think what has done the most for our online reputation is really continuing to deliver a great service. We continue to report a net promoter score in the high 70s, 78 was the last reading, and continue to see a lot of word of mouth and a lot of positive reviews online. And we know that customers check interest rates, but they also check reviews. They want to understand what their experience is going to be before moving forward. And I think brand and reputation of Lending Club really are helping us convert prospects at a higher level and generate marketing efficiency that way.
So I guess it's not just one thing. I guess you're saying that all these things move together. People recognize your brand above your competitors. Your own marketing channels are getting more efficient. The fact that you're driving costs down where others are actually feeling it rise. It's been quite a fascinating story. And so I guess what you're saying, it's every little piece helps. It's not like one of the major things. You're saying like, oh, our borrower channels are suddenly twice as efficient as they were 12 months ago. You're saying it's a combination.
Yeah, it's really a combination of things, and then each of these things really feed on each other and create these marketplace dynamics and platform effects that make things better over time. The other, just to be completely, the other factor we've seen in the last 2 quarters is positive seasonality, where we've said before that we typically have better seasonality in Q2 and Q3 than we do in Q4 and Q1.
Mm-hmm. Right. Okay. So I wanted to talk about risk for a little bit here. And, your longtime Chief Risk Officer, Chow Mei Chen, is retiring at the end of this month, and wanted you to sort of give the listeners a little bit of a background about how the transition is going, who is going to be running your risk operations going forward, and just talk a little bit about that.
Yeah, so we are very lucky to have Sandeep Bandari join us from Capital One just a few months ago. So we had planned for this transition over many months, and were able to transition smoothly the operations and the credit policy and the risk strategy over that period. There was enough of an overlap there, so really happy with how that's been going. Sandeep was pretty high-profile risk officer at Cap One. Been spending the last 15 years there in mostly unsecured consumer credit, and I think he has the required experience certainly to lead the risk function. So we're pretty satisfied with where we are from that standpoint.
Okay. So another question on risk, and this is around sort of, identity and fraud and that sort of thing. There's been there was a lot of talk in the last month about, the San Bernardino shooters and the loan they got from Prosper. So I'd like to take this opportunity for you to explain, what exactly you do to identify your borrowers and what steps you take to prevent fraud.
Yeah, and to be clear, I think our understanding of the case is it's not an identity fraud issue.
Right.
And Mr. Farooq did not pretend to be someone else. So his identity was verified by Prosper according to their processes. And I think the question was, should there be additional checks and verifications? I think it's hard to imagine a process that would have caught what happened.
Yep.
This particular person had seemingly a pretty stable employment, had been around for a while. The person had bank accounts. They actually used their bank accounts to withdraw cash just a few days before the event. And there was no identity fraud being committed. So it feels like the process, the procedures have worked the way they were designed to work, and the same loan could have been made by any other bank. I think as far as we're concerned, our BSA and AML procedures are very much bank grade, and I think they're as robust as any similar process that would have been carried out by a bank. In fact, it's all approved and reviewed also by not only by WebBank but also by all of our bank partners. And the fact that we have so many banks, including some of the larger banks in the country like Union Bank and Citibank, working with us and purchasing loans from us and carrying DSA and AML audits on lending side, I think is very comforting. And I think it's a good question we should ask ourselves of what more can be done. But it's not obvious that this particular case could have been avoided through any additional checks or forms, or at least we haven't thought of anything that would have allowed that to happen.
Right. Okay. Yeah, makes sense. That makes sense. So another thing on risk I just want to talk about briefly, there's been a lot of chatter, I know, on the Lend Academy forums about it seems to be a spike in charge-offs recently, particularly in your higher yield 36-month loans. Is there any reason you're finding for that? Can you give any color to that?
I don't think so. I mean, there's plenty of more volatility in the higher yield loans, and some vintages underperform and overperform. We constantly sort of adjust risk and interest rates in a way that sort of preserve those high returns we've seen for investors over the last several years. So we continue to manage each particular bucket accordingly. But there's been no systemic shift here, and we certainly haven't seen any sort of overall degradation of the economic environment or the credit quality overall.
Okay, fair enough. So I want to switch gears a little and talk about partnerships. It was reported that you guys are doing a small business loan pilot with Google for their AdWords program. You've announced a ton of other partnerships this year, like Alibaba and others. Obviously, Google AdWords is that's a massive. I imagine would be massive demand there if you were to roll that out. I mean, can you comment on the pilot that you're doing with Google AdWords?
Peter, I probably won't surprise you if I tell you I can't. We don't comment on partnership discussions either way. So I can't deny or confirm.
Okay, well, there's been screenshots taken of Lending Club loans that are appearing for AdWords customers. So anyway, we'll stay tuned on that one. So what about your LCOI product? You launched that a few months ago, trying to attack, it seems like, the advisor market. So can you explain a little bit about what problem you're really trying to solve with making it easier for third parties to open up accounts and that sort of thing?
Yeah, so it's really a distribution channel for us. As you know, we've been very active in preserving the share of retail as a percentage of total funding. Mm-hmm. We've been fairly successful in preserving that in the 20 to 25% level as far as self-directed retail is concerned, and then another 40% for managed retail. Some retail investors want to come directly to our website and then manage their Lending Club account through the Lending Club user interface. Others are happy of using intermediaries and look for an additional layer of analytics or different UI. And we want to make sure these customers benefit from the same level of service from us, and we want to make it easy for customers to buy Lending Club notes, whether it's from the Lending Club website or from any other financial advisor or online brokerage operations that they are already familiar with. So we launched a very robust set of APIs that help financial advisors and online brokers integrate with the Lending Club, loan trading and notes trading and notes reporting platform in order to enhance that experience.
Mm-hmm. Okay. Yeah, it seems like it's a really big market that hasn't kind of embraced marketplace lending yet, and it's interesting to see how that evolves. So what about your small business lending operation? Now it's been almost 2 years since you started it. Can you give us an update there, and also any plans to add these loans available to retail investors?
Yeah, so I think we see that as part of the expansion in the next few years. I think we said that when we're going to launch a new product, it's not going to be immediately available to retail because we want to get a really good handle on performance before we sort of expose retail investors to that risk. And I think with small business, we've made a lot of progress over the last almost 2 years in terms of predictability of performance. We've made we've gone through a couple of iterations of the credit policy already. I think the next step is probably going to be the creation of a fund to sort of aggregate individual investors into a fund before it goes to self-directed retail. In the way we see the funding cycle is to use a few institutional investors to launch the product, gain some level of predictability in performance. Then the second step is creating a fund or opening an existing fund to buy in small business loans. And then the third step only would be retail at the point where we're really sort of confident on performance.
Right. So would this be a fund like the LC Advisors Fund that would be run through LC Advisors, or are you talking about doing some kind of public fund? I mean, can you elaborate a little on that?
I think both are possibilities. We've talked in the past about the fact that we're exploring public funds. So I think the small business, the next sort of step in funding small business could be using either a private fund like an LCA fund or even a public fund when that structure is available.
Okay. So then let's talk about regulation and your efforts in Washington. You had a very detailed response. I think yours was the most detailed response actually to the Treasury RFI, and I think there was a lot of really interesting stuff in there. But when you're talking with the regulators today, I mean, what is the mood in Washington, and what are the efforts you're making around regulation and any possible regulatory changes?
Yeah, so I think there's no question that as we get bigger, as the industry gets bigger, there will be sort of more and more sort of oversight from regulators. I think we welcome that oversight, and we believe the sort of level of oversight will really depend on the type of products being offered and the way banking regulators have approached us and the way discussions we've had with them continues to be centered around making sure that we continue to be as consumer friendly, as transparent, and as responsible with our credit products and credit policy as we've been so far. I think as long as we continue to design our products in a way that's fundamentally good for consumers and small business owners, I think the level of oversight will be more in the sort of checks and balances category than in anything that would create undue friction to us or to our customers. I think what we've done, for example, after the Springstone acquisition of immediately terminating that deferred interest product that Springstone was offering and replacing it with a full no interest product was one of these moments where we showed regulators and consumer advocacy groups and the public in general that we were serious about running a consumer-friendly, transparent program, even though the new product has a 40% lower margin than the old product. So we really put our money where our mouth is. I think that's the kind of moves that really establish our brand and our credibility in Washington. And I think as long as we continue along that strategy, we're really not fearing any new regulation that would have undue costs on the business.
Okay, so I just want to have a follow-up here. I was speaking with somebody at the American Bankers Association, and they were saying that, the regulations they don't think there's really any need for major regulatory reforms. But what banks have that marketplace lenders don't have is oversight. You don't have the OCC coming into your offices, or at least I imagine you don't. Maybe you can share, but there's no government agency coming into making sure that you're doing everything that you say you're doing. So, which, imagine for Lending Club, it's not that much of a big deal, but I'm thinking about for newer platforms who might want to cut corners and do things where the regulators don't like and that would be bad for the industry. I mean, firstly, I guess the question is, do you have any agencies coming into Lending Club for oversight? And secondly, what are your thoughts on it?
Yeah, so I think that's right. So so far the FDIC is having web bank, and Lending Club is a program of web bank. So there's certainly some oversight there, but the FDIC doesn't come on premises at Lending Club at this point. And the CFPB already has enforcement powers over many consumer protection rules, like anything that has to do with fair lending, UDAP, truth in lending disclosure, and so on. I think that's about to change and be reinforced when the CFPB adopts rules on larger participants in installment lending, which we are scheduled to do in the first half of next year. And that will sort of provide additional oversight. And assuming Lending Club is named as one of the larger participants, that will allow the CFPB to have sight visit like any other bank regulator would have to have a on-site due diligence and auditing and examination process.
Right. So it sounds like you would welcome, or you wouldn't be against such oversight.
No, not at all. And I think, in that matter, as in any other matter, if you go back to our competitive advantage against the banks, it's really the ability to use technology to reduce costs and automate tasks that would otherwise be manual at more traditional banks. And compliance is an area that really lends itself well to automation and process improvement. It tends to be fairly repetitive tasks where automation actually not only lowers costs but also increases the level of compliance because there's less of a risk of human error, human mistake in the process. So we think we can continue to build compliance as a competitive advantage, being both lower cost and higher level of compliance that you would see at the more traditional environment.
Right. Okay, well, before I let you go, I want to just touch on self-regulation. There's been several initiatives that have come across my desk for some kind of industry association. Can you give us an update on where Lending Club is on the whole self-regulatory idea?
Mm-hmm. Yeah, so I think the Small Business Borrowers Bill of Rights was the first attempt at self-regulation. Mm-hmm. We participated in that effort, and we've seen other companies joining that effort since it was launched over the summer. And I think we'll measure the effectiveness in terms of adopting best practices for small business lending within the next few quarters and see how effective that effort has been. In terms of creating an industry association, I think that's probably going to be inevitable as the industry becomes bigger and more complex. I think to your point, there are several rounds of discussions happening now, and I think it's going to be a matter of understanding who the different players are and what approach is going to be the most effective in Washington.
Right. So you haven't backed one particular initiative over another as of yet.
That's right.
Okay. So last question. I know you're going to be doing the opening keynote at Lend It USA, which will be in your neck of the woods in San Francisco in April. Can you share what you're thinking about sharing in your keynote this year?
Not in great detail so far, but certainly the Lend It conference has become the largest industry event, and we're really sort of looking forward opening the conference again this year. I think we're generally trying to talk about things that matter for Lending Club and for the industry in general, and trends that we're seeing around technology, around compliance, around products, around user behavior, around credit quality. So all this would probably be part of the keynote. We're also trying to make it entertaining. So last year we showed a new product concept that was very well received. We also flew a drone on stage.
It's a tough act to follow.
Yeah, we raised the bar quite a bit. So we are thinking maybe live animals on stage would be part of it if the organizers let us.
Well, we're fine with it. It's a case of the hotel, but yeah, well, that'll be interesting to see. Anyway, I really appreciate you coming on this show, Renaud. All the best for 2016, and we'll talk again soon.
Great. Thank you for having me, Peter.
Okay, thanks.
Happy holiday.
Yep, you too. Bye. I think 2016 is going to be fascinating year for Lending Club. We're talking about there's a new consumer credit vertical coming up. We don't know what it is. I mean, I said in my predictions post right around the new year that I think it's going to be an auto lending operation. I have no inside information whatsoever. That's just a hunch I have. And, Lending Club, it's very, very hard to get any information out of anybody there that, in advance. They run a very tight ship. So I don't know, but I think that's going to be fascinating. I think we'll see a couple of acquisitions as well. I think Lending Club is in a great position. They are the number one in the industry, and they're getting bigger, and they have a lot of cash. They can pretty much do what they want, but they can certainly have a lot of flexibility in who they want to work with and how they want to launch new products, whether they want to acquire them, whether they want to build them themselves. So I'm very much looking forward to 2016 and seeing what it entails for Lending Club and the industry as a whole. On that note, I'll sign off. I very much appreciate you listening. We've got a lot of great things in store for you here in 2016. There's going to be more podcasts than ever before, and I think we'll try and get as many of great guests on as we possibly can. Thanks for listening. I'll catch you next time. Bye.